Well, folks, the repocalypse continues. It looks like the banking system in the United States is still short on cash. The repo markets have been acting up over the last couple weeks, and most notably, I think it was last Monday, maybe the repo rate, the interest rate, spiked up to about 10%. And so the Federal Reserve has been trying to inject cash into the system to bring the repo rate back down to where they want it, which is 1.75 to 2%, somewhere in that range. And even with the Fed, dumping money into the market and, essentially handing it out for free to try and get interest rates down, the repo rate has stayed above their target rate. And in fact, last night it hit 2.8%. Which is still, if you think about it, like 50% or 25%, no, almost 50% over what their target rate is, which is about 2%. Because when rates are so low, even if you go up, 1%, that's that's half of what the target rate is. If you go from 2% to 4%, you've doubled the interest rate. Now, I'm still unsure of what to make of this whole, repocalypse situation. Of course, I'm saying repocalypse somewhat tongue-in-cheek. I'm borrowing that term from Zero Hedge, but because there are people who I respect who are on both sides of this issue of whether this is a big deal or not. Most people seem to be keeping quiet about it because, like me, they don't really know what to think. But some guys look at this as not necessarily something that's changed in the banking system that's brought about this spike in the repo rate. They think that it's just the Fed failing to implement their policies correctly, because what the Fed's job is to manipulate interest rates. The Fed says, okay, we want X interest rate to be at Y level, and it's their job to try and mess with the mechanics of the market to inject cash in the right place at the right time to make sure that they are able to fix the price where they want it. And so I've heard Bill Fleckenstein, for example, is of that opinion. He thinks that the Fed is just doing a bad job at trying to fix the price. It's not that the banks are necessarily in more trouble all of a sudden. It's just that the Fed is not manipulating prices very efficiently. Because interest rates across the U.S. economy would not be where they are today without Fed intervention. It takes constant Fed intervention to keep interest rates where they are. If it weren't for the Fed, interest rates would skyrocket across the economy because people in America just don't save that much money. So there isn't that much, deposits in the banks. At least not enough to keep interest rates as ridiculously low as we've had them for the last 10 years. And so obviously, if the Fed doesn't manipulate the markets as effectively as they have been, well, then interest rates are going to spike anywhere in the market. That's not necessarily meaning that anything in the market has changed other than the Fed. And so that's one school of thought on why the repo rate has been spiking. It's just all of a sudden the Fed, can't get their game together. Now, my question when it comes to that is, well, why is it all of a sudden now the Fed is having trouble manipulating the repo rate? The Fed's been manipulating the repo rate for, decades. Why is it now that we've got this 2-week period in which the Fed just can't keep it under control? That would seem to signal to me that there is some bigger problem going on in the market, in the financial sector, a problem with the banks. And that whatever this problem is caught the Fed off guard, and now they're having trouble responding to it to keep prices fixed where they want. There's this sudden surge in demand for overnight funds that the Fed was not expecting. Oh, and I guess I should, just in case, review what exactly the repo rate is and what the repo market is. I kind of glossed over that. The repo market just means, it just means repurchase agreement. And the way it works is that if a bank, banks have to hold a certain level of cash reserves at all times, by the end of the business day. And so what they'll do is they will borrow money if they're a little short at the end of the day, to cover up to their necessary reserve level by selling some of their assets, but then the next morning they'll buy those assets back and go about their day. So this is kind of a short-term loan because the institution who buys whatever asset from the bank, usually they are treasury bonds, they get paid a fee, and that's the overnight rate. That's the repo rate. It's the fee that the other institution is getting paid by the bank who's borrowing the money overnight. And so if we see a surge in demand, because there's two sides to every one of these transactions. In order for a bank that's short reserves to borrow money overnight, there needs to be another bank that is flush in reserves, that has more reserves than they need, that can lend overnight. And so when we see a spike in the repo rate, what that means is that there's relatively more banks that need money than banks that have money to lend out overnight. It means that the banking sector in general is short of cash. Now, speaking of reserves, the whole idea of the minimum reserve ratio is that the Fed mandates banks to keep a certain percentage of cash in their bank to back up all of the deposits that people have with that bank, so that at any given time there's less of a chance of a run on the bank that would make the bank go bankrupt. And until 2008, it was customary for banks really only to keep enough cash to cover whatever that minimum reserve was that they needed. However, since 2008, the Fed has encouraged banks to keep excess reserves, and so the Fed, in order to encourage that, has paid them interest on excess reserves over the minimum level that they can deposit in the Fed directly. And so, after 2008, we saw an explosion in what was called excess reserves, meaning reserves over the minimum that banks were holding. And the idea behind this is that, well, if the banks have so much excess reserves, reserves over the minimum, so much more money than they actually need, well, then they won't, get into as much trouble of being short of cash. The idea is if you have excess reserves, you have more cash than you need, not just the minimum. So you shouldn't really ever even need to go into the repo markets and borrow overnight. And so you would expect that there wouldn't be any problems in the repo market. You wouldn't see spiking rates until perhaps after all of those excess reserves had been drained out of the system. And while excess reserves did peak in 2014 and have been in decline since then, a pretty sharp decline, we're still not back at zero. From what I can tell, there's still a lot of excess reserves in the system, and so I don't understand necessarily why the repo rate would be spiking, unless it's just that the banks that have excess reserves aren't willing to loan money to the banks that have below the minimum reserves, the ones that need to borrow money overnight. Perhaps that the banks that still have cash, the banks that are holding all of these excess reserves, perhaps they see the ones that need cash overnight as being too great of a risk to loan overnight at the 2% rate, when they're already getting paid something close to that, by the Fed for keeping their excess reserves at the Fed. And so it seems to me that if the Fed really wants to solve this repo problem, what they really need to do is cut the interest that they pay to the banks on excess reserves, and then these excess reserves will start flowing out of the system. Of course, what the Fed has chosen to do is just to try and come into the repo market themselves and inject that money in, but that seems to be a short-term solution. And frankly, so would be cutting the interest rate on excess reserves, because then, of course, once those excess reserves are finally drained out into the system, eventually, they're going to run out, and then the repo rate is going to spike again anyway. But like I said, the key here is that in reality, in the banking sector, there's not a shortage of cash, at least not that I can see in Fed data. It seems to me that there's a shortage of cash at the 2% interest rate that the Fed is targeting, meaning that the risk premium has risen in the repo market for some reason. That, to me, is the real story out of this, is that in order for all these things to happen that we're witnessing, in order for everything to make sense, all that I can glean from this is that there's more risk in the repo market. And that means to me that the banks that are borrowing money are starting to get into trouble, and the banks that have money to loan out know it. The banks themselves must see what the risk is. It's something that perhaps is not directly perceivable to us lay people, or even to the guys on Wall Street, because the stock market really hasn't been affected by the repo market. They seem to have pretty much shrugged it off. But nevertheless, this problem doesn't seem to be going away, and the Fed has pledged that they're going to continue to do repo operations through October the 10th, and I imagine they'll have to extend it past there, because it seems as though this repo flare-up is not calming down. So if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.